Good morning, ladies and gentlemen. Well, I have to admit that after reviewing all the charts and the price action for the week, I have to admit that I haven't felt this ambivalent for a long, long time. There is nothing on the surface that should be worrying, but I will explain my dilemma. To start off with, the risk dial is not moving against risk at all. It is rock solid at 89. These minor daily pullbacks are doing absolutely nothing to the risk curve. And the score is much the same. On a daily, weekly, whatever you look at, we are in a strong risk on trend. Yet certain things are beginning to worry me, and they're all in the fixed income side of things, so let's look at those first. Before we look at the fixed income, this chart is explanatory of what my worry is. Throughout this rally and throughout this period of very, very low interest rates and long-term interest rates, we've never really traded above, with any consistency, above the times 22 forward earnings. Now, what happens if we decide that because interest rates have backed up so far that we need to go back down towards, let's say, 21 times, if not 20 times? Well, you can see how big the drop would be. The drop would be all the way down to here, which would be around 3,700. So, there is reason to worry, because if we've been arguing all the time correctly that the market is going to go higher because multiples are going to expand, what now that we are already expecting $180 of earnings, which I think is almost impossible to be realized, we actually go down to 20 times, 21 times forward earnings, which is not unreasonable. Well, the market then has some room to back up. It's beginning to be a worry, because I did not expect the yield curve to do what it's doing, and let's examine that now. First of all, 2s, 10s, in a shortened week, we've tacked on, the best part of 12 basis points. That is a hell of a lot, and we are rapidly approaching the 126 level, which you can best understand from a weekly chart. This is, this is a monthly chart. You can see how far we've backed. It's from 60 basis point, from 6 basis points down here, almost flat, almost zero. We've gone all the way to 122 basis points in a matter of, months. This is a huge move, and it really has to weigh on the economy. I know that the monetary conditions are still very loose, but this is this is very worrying. You can see how here it stayed at this level for good 3-4 months before it started coming down. If this continues, we will then we are likely to experience some volatility at some stage. I refuse to believe that the equity markets and the risk markets in general are going to just sit through kind of volatility and what this yield curve is saying, without even giving up, a quick 3-4% in one day when someone pulls the rug. It's very worrying. It's getting to very worrying levels, and coupled with the other charts, fixed income charts, I just can't see that at some stage we don't get some kind of an accident. Every single part of the yield curve is saying the same story. I've been trying to fight it. It doesn't work. 5s, 10s, it's closed very badly. Could it go down to 114 basis points? Yes, easily. It's an acceleration. It's very, very bad. If we now look at 530s, which I consider extremely important, it's broken through the 154 level. Where's the next support? Well, there really isn't very much support all the way down to 238. That's another 70, 80 basis points of steepening. That is a huge tightening of financial conditions. And even the one that I tried to do something with, which is 10s, 30s. What do we know? What's going to happen in 10 years' time? It's not looking good. It's looking like it wants to break the lows, and if it does, then just to show you, it goes back a long way, in time. You have to look to 2017 to see it any steeper than this. And once it breaks, it just goes a long, long way. You see, this is where we are, and we haven't been steeper than this. Well, you have to look at 2014 and 2013, and then it went to 120 points. So that's another 40 basis of steepening. That is a real duration strike. And if these things continue to happen, and there is absolutely no evidence, the charts are screaming at you, the yield curve is steepening and it's going to continue to steepen, there is almost no chance that we come through this unscathed on the risk side. If we look at the outrights, well, you can see that, we try to hold in here around 119 yield on the 30-year. We are now going to 237. If you look at the equivalent in TLT, that is exactly where I said we would be, around 137, 135 in TLT. These are big moves, big outright moves, and the speed of it. 1, 2, 3, 4 days, and we closed at the worst. If we keep on doing that, in 2 weeks' time, we're going to be at our targets. And I think when we are at our targets, people will actually start switching. They'll start switching out of risk into bonds, because the yield will be just so good. I think the odds of something not happening in risk over the course of the next 2 or 3 weeks are receding. And when I say something, I mean something bad. Either we decide that we can't hold the forward earnings multiple, or people just liquidate, because it's cheaper it will be cheaper at some stage to be in bonds and get that yield than to run the risk of equities at these valuations. So the odds are really rapidly turning that we will have some sort of give up in risk. On a longer term chart of the 10-year note yield chart, you can actually see how important this 140 level is. It was the bottom in 12, it was the bottom in 16, it was the bottom in 19, and when we broke through it, we went a long, long way. Now we are retesting it. It's inconceivable to me that the Fed is not looking at the same things that I am, and it's inconceivable to me that they don't start to do something about it. But maybe, just maybe, they're going to say, let the market do its thing, and let equity valuations be undermined by the bond market. We have plenty of ability to do something about it if it gets too bad. Maybe they do want us to have a little accident, who knows. All I know is that this is something which has to worry me, and on Monday, first thing, I will be reducing my equity exposure simply because the risk reward is not there. Uh, Whether we do it through volatility or however, it's just not something that I feel comfortable with anymore. I wanted to show the charts of Bund and Bulbul as well because they're at critical levels, and if we go through here, really we don't have anything for another, what is that, minus 48, minus 61, 13 basis points. 13 basis points are in the 5-year note in Germany is a hell of a lot. It's a worldwide phenomenon. Yields are going up everywhere, most of all in the States, because the States has got the most to refund, but it's a worldwide phenomenon, and therefore it's a worldwide problem. In the Bund, I think the target now, having bust through this level, is now minus 22. And I think at some stage next week we get it. It's another 8 basis points. All yields are going higher, and stock markets can withstand that for a long time, and and then at one point they just give up. We need to examine when that point might be, and what the trigger will be, and what the signal to us that it's happening might be. Before we examine equities, I want to have a look at the dollar and gold and give you my theory as to how they are correlated to what is happening in the rates market. I think the fact that the dollar is not going up with the steepening of the US curve and the widening of US spreads against nearly everything is indicative that no one is buying dollars to buy bonds, and therefore that the trend in the fixed income in the US is going to continue, i.e. it's going to continue to bleed to the levels that I showed you. Well, if that's the case, the support for the dollar is very weak. You can see how every time it gets to this 91.01, it can never sustain it. I think the risks of a breakdown in the dollar are increasing, not decreasing. It's counterintuitive, but I think the path of least resistance is at the moment probably sideways, but at some stage down. There is nothing, every week that goes by that we are doing this just in a 1% range, it's a week which allows the maths to do its work and these moving averages to come down further and offer resistance to any move up, lower down. It's, to me, this is almost over. In a month, 2, 3 months time, whatever it might be, the dollar is going to break down and break down hard. I would still be very, very wary of trying to buy gold. Now, it's, as I've been saying for a long time, it's a second derivative of the dollar and real rates. It's therefore under pressure. The dollar is going sideways, and that is not helping it. It's not hindering it, but it's not helping it, and real rates are going higher, and that really is putting pressure upon it. I think the odds of not breaking this 1764 level at some stage over the next couple of weeks are fairly low. But do I think that it's a buy at these levels at 1710 and then much more importantly at 1658? Yes, I do think it's going to be a buy, because at some stage rates just stop going higher, and then it's going to have quite a bit of room to rally. But I think that liquidation will take place first, because it always does. That's what markets do. They force you to liquidate at bad levels, and then they just skyrocket without you. Those are my levels. That's what I'm looking at. 1710 first, and really 1658 is the level that I would really like to be able to put on some decent call spread positions for at least 1900. We have seen how fixed income is most likely going lower to achieve the targets in TLT around 135. Well, in which case these charts have to be worrisome. This is ITOT government on a weekly basis. And you can see that on the week we made a very, very slight new high. But you can see how far away we are from moving averages and real support. We are as far away now as we have ever been stretched on a weekly basis. And on a daily basis, what I found interesting, and I don't know, maybe I'm reading far too much into it, is that on Friday we didn't manage to make a new high, even though bonds were falling out of bed. Now, this might be nothing. I might be really over reading the technical situation, but even on a daily basis, you can see how stretched we are. And if bonds are going to continue falling, and equities are actually going to not be able to make new highs, that to me says that the odds of a bad break in equities are actually increasing. Before we look at the absolute levels in equities, it's interesting to look at the thing that I said a week or two ago, I can't remember now, that it didn't make sense, and that was that the tech spreads were actually powering ahead. Well, look at them now. This is this is the Qs against SPY, and if I actually try to zoom in here, and I don't know whether I can, let's see what happens. Yeah, it's you know on Friday it just broke back below. I think the Qs are very, very susceptible to a fall down to the 200-day moving average here on the spread, which is around 82, which is 2.5% further down. They're very, very susceptible. And all the tech spreads, apart from XLV, XLK, which is making no sense, are beginning to turn in favor of the others. XLF, which is is trying to make new highs against tech, and that makes sense. So really, since tech is 35%, if we are looking for some kind of a little accident there, that would explain it. It's not really apparent from the outright charts, and let's go and have a look at those. And that is why I'm saying it's only the odds that are increasing. I see nothing that is confirming that we could have it, but I'm just painting a picture for you. I'm saying I'm becoming uneasy because certain things aren't happening, or some other things are happening. It's worrying rather than definitive. Right, let me paint the picture. The one index which says absolutely nothing is going on here is Dow Jones. The Dow is absolutely spotless. It's not weak, it's not strong, it's not doing anything. It's basically saying that we are steady as we go, and there are absolutely no reasons for worry. The Dow basically needs to break on a closing basis below 31,165 for me to even start thinking that contagion is taking place. As far as I can see at the moment, this seems to be a little bit of tech weakness because of the steepness of the yield curve, nothing too pronounced, and that is affecting the Dow least and slightly more the S&Ps. And that is all. But I'm very weary that the contagion will spread, and therefore I'm making a game plan for what to do if it does. That's all. And I want to have my game plan very well defined, and because I think as I've said, the odds are increasing. Since my main worry has to be in tech, I have to look at that first. Here's my level, 13,400. Any daily close through 13,400, and I'm going to be dumping out a whole load of my, tech positions. This chart is doing nothing wrong, absolutely nothing wrong. It could very well be that I'm, sort of being worried about anything, about nothing rather, and so be it. But the inability on Friday to sustain the levels and push further in SPY TLT or in ITOT government, to me is a first warning sign that we are too high, that we're getting a nosebleed, the valuations are finally beginning to matter and overcome the endless liquidity. 13,400 and you have your first warning sign, in which case we probably go down and test all the way down to 12,800, let's call it. The S&Ps are also quite simple, 3861, call it 38, yeah, 3861.45, who cares? That is that's the level below which, if it closes, I am definitely worried and definitely selling. There is no reason, but the market has given me a bit of a worry on Friday. The inability to just continue. They had the bears on the run. They could have gone into 39.50, closed it up there, and got everyone bulled up for the rest of the week, and 4,000 would have been in sight. Now, is it a false lunge? Maybe. The Dow Jones, as I said, is saying everything's absolutely fine. The Nasdaq is giving up some because of the yield curve, but to me, at any moment, the market could say, my God, we need to be at 21 times, not 22 times forward earnings. And that would take us down here, into the 3700s again. So I'm prepared to give it the benefit of the doubt until 3861. Beyond that, I'm not really prepared to give it the benefit of the doubt. 36, 23, 24 is going to be the real support from which it probably bounces a bit. But if it does that, the path of least resistance will tend to be down towards the 37.76 level. You sell the bounce rather than anything else. Now, the one dog which is not barking is volatility. Every day last week, volatility got sold, and that gave me an indication that the market was not ready to break down. I'll be watching volatility like a hawk. What the market could be saying is that we're just going to go sideways. That is a distinct possibility. As the yield curve continues to steepen, certain sectors do better than others, and take up the slack and take up the leadership. That is very possible, and volatility could be absolutely right and saying that we are going to go absolutely nowhere. Is it likely? I think it's less likely than that we have an accident at some stage, but it's not impossible that we just go another week absolutely sideways between, 38.80 and 39.40, 50. That kind of range, in which case volatility would be right. It would come down towards this 20 level, and probably break it a little bit, and that makes perfect sense. We just do nothing, but the markets don't like to do nothing for very long. In any case, I'm very mindful that volatility is telling me that absolutely nothing is going on. I would need to see an uptick in volatility and a break of 38.61 SPX to really say, yes, my worries are founded. I just think that it's most probably going to be just a period of whippy trading with some very nasty pullbacks down to that 38.61 level that probably holds. We shall see, but I'm definitely this week much more uneasy about my views than I was only last week. I haven't changed very much in this sheet simply because the trend just keeps on going and there isn't very much to change. 5s, 30s and 2s, 10s, 126 and 154. Beyond this 154 level, there's nothing for 25, 30 basis points. It could be an absolute bloodbath in bonds. And that makes me worried. Makes me worried, especially for NQ, because as we saw on Friday, it finally broke back against SPY below that line. SPX could not hold the 37.25s. It's fully valued. The odds of an accident are increasing. Let's face it. Now, Nikkei and EM have reached all the objectives. I said 30,000 will trade when it was trading, sort of 23, 24,000. It's got there, and now it's just the laggards buying. So it's vulnerable. Everything is vulnerable. I don't think if Nikkei gives out 3-4%, which is like, why shouldn't it? I think SPX gives up at least half. So it's beginning to be much more worrisome than it was. 13,600 is going to be very, very interesting. I would equate this 13,100 level in SPX with 13,100 in NQ or NDX with 38.25 in SPX. Those are going to be absolute key levels. But the first one is 13,600 and 38.61. Those go. I think we have our warning shot, and we will know what to do. We will definitely be looking to lighten up and sell some or trade some from the downside, buy some protection, because I think it definitely then things get much more hairy. Thank you very much indeed, and have a great Sunday, and I'll tweet you tomorrow.